Thanks, Rick. I am going to talk about the use of risk management tools in the beef industry. As mentioned, I work with AFSC. My specialty is the Western Livestock Price Insurance Program. It will be a tool I discuss, but there is 4 other tools I will go over. Not in too much detail, it's going to stay pretty high level for today. There is a lot of experts out in the industry that you can get more information from, but I wanted to give a synopsis of what we have available, what cattle producers have available, but again, still not my specialty, so bear with me. We're going to go through a bit of an outline first, so I'm going to talk about the background to risk management. Then I'm going to go through the market influencers, what to watch out for and where to watch it. The 5 tools will be discussed, and then I'm going to do an example from comparing 2017 using tools to 2016 using the tools. But I think there should be some clarity to what I'm going to talk about before I get started, so I want to do a quote from Alberta Agriculture's Ron Geets. A risk management plan is part of a good marketing strategy. The marketing strategy is about revenue maximization, while the risk management plan is about reducing the variability of returns and proving greater stability of cash flow. So regardless of the type or depth of your operations, risk management or marketing plan, the most important aspect is to have a plan and be disciplined about it, especially when selling that asset. So I'm going to speak to you as if you are cow-calf producers and assuming that the asset you're going to have to sell is calves. So that's just going to provide the context of this. But one of the biggest reasons for having a marketing and risk management plan is to not only add to your bottom line, but also increase your access to capital. And I believe there's a fair number of people here in the financial industry that will attest to that and help their producers, clients, I guess, in your speak, understand that. And when it comes down to it, every producer wants to make money, and no one blames them for that. But is your operation maximizing the tools available? So first, let's talk about what marketing is. Marketing is the active act of selling your cattle for cash. It's planning how you're going to sell it, where you're going to sell it, based on the information you have on hand prior to the transaction. It's not predicting the high price. Secondly, let's talk about risk management. It's the act of protecting your equity. It's taking steps in the production cycle to achieve the reassurance that you're going to be in business the next year, and also that your assets are safe from adverse effects prior to selling them. Watching the market is not risk management. Are marketing and risk management synonymous? No, but they do dovetail into each other, and that's what I'm going to get into in the examples that I talk about and how they fit together. I'm way behind. There we go. So I know the Halloween's over, but we have to address a few scary things in this discussion. Number 1, price movements and price and market movements. Number 2, volatility. It has been said that investors generally feel a financial loss 2.5 times more than a gain of the same magnitude. I believe the same is true for people selling a physical commodity. That said, there's always a range of emotions associated with price cycles, as shown on this graphic. And the important part of all of this is to keep calm and carry on so we don't make emotional decisions during times of volatility and we stay on a direct line to success. Now, the one disadvantage cow-calf producers have is typically on operations. There's one product to sell once a year. We don't have the same luxury that all the feedlots do, and that they have more turns of cattle to sell, so they can capture more of these market emotions. But we sell once a year, we feel these emotions all year long. So I'm just bringing this up to remind you that it's a natural to have some emotions with the market, but the important part is to have that plan and stick to it. Next, I'm going to talk about what to watch out for. So I'm not going to dig into what Anne did. Obviously, we've listened to that and we've learned a lot. But what I want to talk about is what's impacting the prices fluctuations and where do we want to go to watch them. So the first one is obviously the futures trading. That's off the Chicago Mercantile Exchange. It's the primary source of forward pricing for the cattle markets. It's daily trading, and it captures the ever-changing market environment in the U.S., and it quantifies it into 2 categories, which is live cattle and feeder cattle. Those are the contracts offered. The movement of the futures market dictates where the market is expected to go locally, because cash will follow the futures. Think of the futures as if it's a macro situation of the cattle industry, more so the U.S. Obviously, as price takers, we are impacted by it, but think of the futures as that macro situation. Secondly, we're a country that's dependent on trade, so the currency value is a second contributor to our price fluctuations. A Canfax quote is that for every cent the Canadian dollar moves up, the price of 550 weight calves will go down by 5 cents. Next, oh sorry guys, I'm behind. Next up, influencing our markets is basis. And as Anne mentioned, it's the quantification of price divergences between different markets with the same commodity. Local cash market to the futures, for example. It's largely based on supply and demand factors. There's also some border fees, transport fees, etc. Think of it as the micro situation. It's what's happening locally and how we compare to the other markets. Next up is supply and demand drivers. Everybody could add some comments to that scale graphic. The ones I've got is US Canadian herd expansion, rancher profitability on the supply side. Demand side, we've got trade, politics, consumer trends. We could go on for days. That's what Anne's presentation hit on. We all know that that's an impact for us. But something to keep in mind too is that all of these news articles, so to speak, impact our prices. Fifth up is cattle on feed reports, still tied to supply and demand, but I wanted to mention it anyway because it's actually a good barometer for traders and producers alike, really, to gauge the volume of cattle that are expected to come into production and into the markets in the upcoming months. And this is what's giving them some trade signals for prices. So I wanted to mention it. They are published provincially, nationally, and in the US. So keep in mind, sometimes if you see markets move on a Monday, cattle on feed reports in the US published on Fridays, it's a good thing to check into to see if that's what drove it. Lastly, weather. It's something that we can't control, but it's just as unpredictable as market prices and an influence nevertheless. So where do we watch for these influencers? Well, the first one would be futures market, cmegroup.com. They have some good graphs. There's also different offshoot companies like barchart.com. They do a lot of graphics that you can kind of dig in, make your own charts, and just take a look at what you think is going on. There's a lot of people that write weekly information and analysts too. So don't try to recreate the wheel, get familiar with the futures prices, but know that there's a lot of people that you can follow to just do that work for you, and then you can read what they write weekly. Second, currency, check out Bank of Canada. There is currency trades on the futures market too, so you can go to cmegroup.com, find them both if you want. CanFax does a free information sheet every 6 months. They've also got their weekly market report if you're a member. They're a good source of information. Various company newsletters, as mentioned already, the every 2 weeks, realag.com with Ann Wasco. Really good market information, keeps us current and up to date. And lastly, if AFSC does a weekly market information, it's graphs. It's not any text to it, but it just gives you some, we try to share our data. We want to be as transparent as we can be, so we've published them weekly, and you can just take a look at what our settlement graph looks like, what our basis is kind of trending at, what our calf to feeder spread. There's a lot of information up there, so it's one that I would go to take a look at basis, because everybody's different in how they calculate basis, but it can be your benchmark. So before we get into any risk management, I want to talk about 3 key things that I think every producer does already, but maybe could do a better job of. One is knowing your costs. So it's important to hone this skill because it'll improve your chance of success. Knowing your individual costs is best. Obviously, that's your break even, your cost to gain. Digging into your own numbers is, I think, the most value for you, but I do appreciate that it is a bit overwhelming, especially if you're starting from scratch. There is some really good tools out there. I'll get into another tool in a minute, but I just want to point out that it doesn't matter how far you go into calculating your own costs, just knowing that you should do something. AgriProfits is a benchmark tool that Alberta Ag publishes. You can't even use those, but knowing that they're a benchmark if you're not ready to dig into your own numbers. Knowing costs is important. Second, knowing your risk tolerance. This is where you can only gamble what you can lose. Everyone is different, so your risk tolerance in your own operation may be different from your partners or from your neighbors. That's okay. Just knowing what it is will help you make some risk management decisions. Third, know your cattle. Now, I don't want to seem like this young girl's trying to tell you to know your cattle. I'm only saying that because it'll help you make the decisions for, say, forward contracting or delivery sales. Like for delivery sales, you're going to have to negotiate some specifics within those contracts, whether it be shrink or delivery, that sort of thing. Knowing what your year-over-year weaning averages are or what your expectations is of that year's calf crop will go a long ways in saving you some money so you don't have to pay out contracts based on specifications, and also just helps you make sound decisions before signing up. And we're lucky we have Bruce Viney in the room, and he's an Alberta Ag employee. He was helpful, and he's actually a really good resource. But one quote I wanted to say from him is, successful managers make forecasts and then create strategies for when it goes wrong, either better or worse. So it's important to know, always have a plan A, a plan B, and probably even think about a plan C. But before we get to planning, let's go back to some of our numbers. So I wanted to highlight a tool that's developed by Alberta Ag, and it's called Ranchers Risk and Return. It's a free download off the website, and I don't want to get too far into these numbers. This is numbers I did from March, so they are old and irrelevant at this point. But the blue is what you can update. So you can modify this to your own operation, and the black will be what comes up for you. These are the calculations done for you. I think it's just a really good tool to use, and then you can come up with your break-even cost per pound down at the bottom, therefore helping you make some of those decisions. This is a good tool. I know that there's also a good tool out of Manitoba Ag, and it's, I think, called Heifer Retention Calculator. So just don't be afraid to get outside of the province to download this one, but go see what other ministries have developed, because we're all doing the same thing. We want the betterment of the industry. So there is calculators out there. And if you really want to turn it back to the basics, you can go against Excel and you can go back to the 70s. And this is another calculator that the Alberta Ag had published, and it's how to use your Cattlemen's Calculator. So everybody's welcome to use whatever tool they want. I just want them to start crunching some numbers. Now I'm going to get into the tools available. Like I said, there is 5. The first one is no risk management. So here you're going to say, well, what the heck? No risk management, that's not a plan. Where I disagree. I believe that if you know your numbers and you know your risk aversion and you choose not to do anything about the market, that's fine. That's a plan in itself, albeit risky. I do believe that it is truly a plan. But I do want to call your attention to the top corner of my tools. I will be highlighting if it's a marketing tool or a risk management tool, and that's why I differentiated them at the beginning. So this is, as you can see, a marketing tool because you're selling on the cash market. Probably auction markets will be your outlet, but it doesn't matter where you sell them. Having no risk management but selling on the open market is a marketing plan, not a risk management plan. It is leaving all of your equity open to the market fluctuations at time of sale, which can be good for you and bad for you. This year it paid off. If you had no risk management, you made the most money out of the fall calf run. That said, you also put in the most risk because if there was a decline, you would have lost a lot of money. Profitability is a driving force behind reduction and expansion of production, and it is the key to accessing capital, which is often the barrier to entry. So for those of you guys that are new farmers, it's often good to, I know it's cheap because there is no cost to this risk management plan. Obviously it's $0. There's not a lot of time, there is no time that you need to put into it, but it's also risky, and then therefore your bankers may not be too much and fond of it. An interesting little concept that we should talk about is some price swings that we saw. So I'm going to quote Canfax again. 2016, from the spring highs to the fall lows, we saw 277 per hundredweight to 168. So 2016, there was a decline, $600 per head throughout the year. Now, obviously, you're not going to have the same exact cattle ready for sale at the highs or the lows because, again, you're selling once a year. But $600 per head is something to keep in mind. This year, we saw swings about 253 to 207, not as bad as we all remember, and then the market took a rally. But it's still 253 per calf that was left on the table, and that's just within 6 months or so. But I do want to highlight this graph I've got in the corner, and it should come up. This is a Canfax graph, and it's showing the average Alberta cow-calf returns for Alberta producers from 1990 to 2017. So 2017 is projected over here on the left. We all know what happened these years. Good money was made. This red line is about $82 per head, that's margin return. What I want to talk about is no risk management. You are actively participating in every blue line. And that's fine, because on average you're making, over the long term, a profit. But the question is no risk management truly beneficial, because you could be eliminating some of these blue lines down here. So that's just kind of food for thought while I go into the rest of the tools. Second tool is forward delivery sale. Again, it's a marketing tool, it's not a risk management tool. I know we're seeing a steady increase in the number of calves forward sold, especially with the Southern Alberta Livestock Exchange having their September sale. 35,000 head of calves went through that sale in one day. Veteran also had a fall forward sale. They're just popping up more and more because it's just less on the cattle. There's no delivery right at the auction market. I see the advantages to it, so I didn't want to be remiss and miss it. But it's not a risk management plan, so there is some things to consider. when choosing this option. And one is knowing your cattle will help you decide the size of the package you're willing to sell and negotiate sales parameter, for example, shrink. Two, the cost of this marketing, it does vary between outlets. So you'll see some of the electronic sales will be a per head commission, others will be a 1% buyer's fee, but with 1% buyer's fee, there's also, it costs money to sell anything regardless of if you're paying for it in the price or if you're paying for it in the commission after the fact. So that's something to keep in mind. And it does take time to get these calves listed and sold. So you have to build the relationships with the people that are listing them for you. You have to get to know how they all work. So there is some time associated with that. Third tool is the Western Livestock Price Insurance Program. So now we've flipped the scales a little bit and we've got a risk management tool, but it's not a marketing tool. So if you take the program, you still have to find a cash outlet for those calves. But it's price insurance to manage unexpected market declines into the future. We've broken it into 3 different programs. We've got calf, feeder, and fed. So we're trying to help producers manage their production at different time frames. We are forecasting forward market price by using the Chicago Mercantile Exchange, a currency, and a basis. So we like to call ourselves a one-stop shop. We've encapsulated everything that you will experience as Canadian producers for that price risk. You do have upside price potential, so there is some pros and cons to every tool available. That's why I encourage everybody to get to know them. But one of our pros is that we have upside price potential while we're managing your downside. So you can, if the market was to fall, you're going to get payment, and yes, you're going to have to sell those cattle into a lower market, but we've captured that payment for you. If it rallies, there's no payment, but you have that upside price potential. There is a cost to this, of course. It is a premium, because it's an insurance policy. The average for 2017, this is in the CAF program, we do see about top coverage purchase for probably 90 to 95% of our policies sold are at the top 2 coverage levels. So I would say on average, this is a higher premium than obviously what we have available because our premium table does give you a lot of options. But this year for calves, it was $587 per hundredweight, which equaled $35.22 per head. I would say on average, our insured index would have been right around 216, 218 with everybody all in, including the guys that bought in February at a bit of a lower coverage. Just some food for thought. I wanted to provide a graphic just to give you kind of a picture of how the insurance works. I've already mentioned it, but when you're buying a policy, you're establishing yourself what we call coverage, which is also your floor price, because as the policy moves through its term and into expiry, which should line up to when you're planning to sell the calves. It depends on what the cash market's doing is what's going to happen to your insurance policy. So if the cash market has rallied from time of purchase of the policy through to the expiry, you're going to sell the calves into the higher cash market because, again, this program is not helping you with your marketing, it's just helping you with your risk management. So you still have to sell them, but there's a better market to sell them into. As opposed to if in that time the market has declined, your cash market's lower, so we're going to pay you the difference between what the average cash market has settled at, because we do use the average market of Alberta, not your own individual calves. What it's settled at here versus what you would insured at, we pay that difference because that's the loss that you're in theory taking in that exact same market with those calves. A policy overview, just a snapshot on how the program actually works. So this is where your policy is purchased, you've locked in your price protection, the market moves upward or downward, and then you move into this, what we call a claim window. This is going to be where you plan on selling the calves, time frame wise, not an obligation to sell them, but just your time frame that you're going to match your risk management to, and then we pay the difference if there's a decline. A premium table from Tuesday. I wanted to just show it because I thought I'd be remiss again if I didn't actually show you what our numbers look like. We are timely because we're pricing it off the Chicago Mercantile Exchange. We're also looking at a forward currency and a weekly basis, but we do have to be mindful of the date. So every time that you are looking at premium tables, take a look at the date, because if you're interested in purchasing, you can only purchase on what is that listed that day. Next up, we choose our coverage expiry date. So you're going to time that to when you plan on selling the cattle. Left side is the insured index. So we have calculated what we think the price is going to do into the future. And on this left side, we're offering you 95%. So anything that falls below this 184, if you were to choose this policy length, you would get paid on it if the market fell early February, late January. So we've already taken off a bit of, I suppose the best way to explain it would be a deductible. So anything below this is payable. And then your premium is associated in that middle there. So that's per hundredweight. So for a feeder example, $7 against an 800 weight, $56, $60, I guess, on average. And that's per head. Some 2016 payouts. We did have a big payout year for the calf program in 2016. On average, there was policies that did not pay. So this is an average of every calf that was insured. So it's not an average of all the actual only ones that got paid out, but average $66.50 per head. 2017, we did see our second biggest calf numbers come on the books from our sales in February through to May. We insured 290,000 calves, which we equate to about 18% of the eligible calves in Alberta. And this year we paid just under $1 million in indemnity for calf producers, and those were paid for September policies. So those $66.50 per head last year, on average, that equated to $14 million that got paid to cattle producers last fall. So that was September to December 2016. That said, I do think that's what drove a little bit of our interest, and that's why 2017 was a fairly big year, but I'm also happy to see that people are considering risk management options. Our biggest year was 2014. And like I said, we're settling the program based on auction market data, so we collect a lot of data. I thought I should share it a little bit with you. I find it interesting. So this is auction market calf volumes for heifers and steers weighing 550 to 650 pounds. So we've taken off a lot of different weight ranges there, and we've just consolidated a bit. Only a 100-pound weight range, but showing you what volumes of market animals went through auction markets for the last 5 years. So this is 2017 here in October. For the last 5 years, it's the biggest October that's come through the markets that we've seen. But I'm interested to see what November 2017 is going to look like. Obviously, that story is still to be wrote with a few more weeks left, but I suspect that we'll be lower than October. I think that we peaked a little bit earlier than typical. We see it in November. But interestingly enough, 2016 was the biggest year of numbers of calves that went through at this weight range in the auction market, for a total of 388,850 calves in those 4 months. So they're busy. Option 4, forward contracting. So this is the only tool that really locks in both things. You capture your marketing and your risk management. It's not to be mistaken with forward delivery, because forward contracting is locking in that price. It is a low risk option. This option doesn't leave anything to chance, upside or downside, except there is some chance if you don't meet contract specifications. Signing forward contracts consistently above break-even prices will ensure long-term profitability, but it also leaves money on the table during market upswings. But conversely keeps it in your pocket during downswings. To quote Twitter, you never go broke locking in a profit. While great advice, forward contracts do require time to invest in the relationships with buyers who are willing to procure the cattle. It doesn't cost any money, but there is quite a bit of time that it takes to build those relationships, and they're never going to be available every year at the same type, or this obviously not the same price, because people that are offering it, if they think the market's bearish, they're not going to be as apt to offer contracts because they think they're going to get a better deal if they hold out and wait. The only thing is that they're going to offer, in a bearish market, they're going to offer contracts if they're short on supply. That's going to be year to year. It's going to be feedlot to feedlot. And that's where I think the time it takes to get those contracts, relationships built, to get those contracts offered, does take, I think, quite a bit of time, and I call that an intrinsic cost. And there may be some minimum sizes required. So not to discount the smaller farmer, but I just think that sometimes there's just, feedlots want those package deals, so maybe full liner loads, and if you can't fulfill that, contracts may not be the way to go. It is recommended that you don't contract more than 80% of your production. Those familiar with the grain side won't be surprised by that. Neither will you guys as cattle guys, but I just thought I'd mention it as a good rule of thumb. The one thing to keep in mind is, on our website, we do have Calf Alberta Settlement Index graph. This is what we update weekly, one of the ones we update weekly. What it shows here, it's tracking from 2014 what we settle. So we get all the auction market data. So we're using our own data to publish this as what we were settling the program. Even though we don't have policies expiring the other parts of the year, we do still track it and publish it for your use on this graph. We often find that calf prices have spring highs to fall lows. So when we're looking for contracts, yes, they're in a spring high, but obviously it's the forecasted price for the fall is what's being offered. So take a look at the graph, see what you think. See if that forward contract that you're offered makes sense. Last one is option number 5, and it's futures and options. So you hear people talking about a position on the futures or even buying an option. Sounds like a good idea. It does. I mean, you've got a lot of risk. Why not take some reward? Because you hear people that make a lot of money off the futures market. But execution can be confusing, complicated, and can make even the calmest person anxious. That's why it's important to get a clear understanding of all the tools. So say, for example, we're going to talk about the futures market. For example, you have your break-even figured out. You know your price minimum, but you don't either have a buyer lined up for that forward contract or you want to give the market time to sort itself out. That's where you can take a risk management option using the price insurance or hedging with futures, because they both give the market time to figure itself out without locking yourself into either delivery or a specific price. Neither of them, again, are marketing guarantees, but they provide that price protection. So a futures market is a free market working as expected to determine prices. So there's people all over the world that are participating in these markets, whether they be actual hedgers who own the cattle or speculators who want to make some money out of some fun money, whoever knows where they are, but they're there. They're helping us provide that forward price discovery on the futures market. The information is transparent and open to the public. You could consider the futures market as basically being a pretend buyer for your commodity, because that's exactly what's happening, is you're predicting what you think the market's going to do into the future, and you're taking a position based on that prediction. Someone else is doing the exact same thing. They're taking the opposite position. So throughout the contract, you're probably both going to be right or wrong, but it's going to have some fluctuations to it, and ultimately it's when you get out the difference between that and what you bought in at is going to be your gain or your loss. Here's a fun fact. The CME has been offering feeder cattle contracts for 46 years now. It's been a long time doing some forward price discovery for us. But again, it's all US based. And feeder futures contracts are based in months, and there's not 12 months offered. It's 8 of the peak months, so to speak. So if you're selling in one of the months that's not offered, you'd go to the next month forward. The theory with true hedging is that you won't go broke managing risk this way on the futures market, even if the position loses money, because as true hedgers, you own the physical commodity, the cattle, so all of your losses are offset. I do want to just touch on options really quickly, because you may hear of the cattle price insurance being mentioned as if it's a Canadianized put, which is true. So options are like insurance. You pay a premium for the opportunity, but not the obligation to participate in the underlying futures market. So what we're doing is we're creating basically that insurance for you off of the CPIP program. So they do call it, some people call it a Canadianized put, just to give you some relationship of what options are like. I don't get into them too much because, again, it gets a little bit muddy, and there's brokers, there's other industry staff members that can help me learn more about that than I could ever teach you. You guys are probably really annoyed with me because I'm not keeping up with my slides. I'm just having fun talking. There we go. So one last slide about futures. As I mentioned, it's each position is someone with market information or the physical commodity predicting where the new future price will be, and that's in the future. So as this is cow-calfonomics, I am going to again assume that most of you are selling calves, probably weaned calves, and to apply that to the futures market, you want to protect yourself against the market falling, because that's what you don't want to happen. You have a physical commodity, you're taking it to the market, so you don't want the market to fall. I'm going to simulate that as if we were a feeder, like a backgrounder that's bought some calves, because there isn't the equivalent futures contracts for calves. There is only live cattle and feeder cattle. So I'm going to, for my example, assume that we're all actually backgrounders that have bought some calves that are going to sell them in the winter as feeder cattle. But both of those people that own the cattle don't want the markets to go down. So they're going to sell a contract to someone who believes the market's going up, and we're going to call that a short position. So we have to set this up a bit. We're going to start out with as if it's the backgrounder that's bought the calves out of the cash market. So he's going to go to the CME. He's going to sell a feeder cattle futures contract. And then over time, the market's going to either go up or it's going to go down. So same scenario, but now we're going to assume that there's a market decline. So he's still bought his position. The feeder cattle futures have now gone down. It's over some time, and he wants to get out of it. So what happens? Well, the market went down, so that's what he didn't want, but that's what he was predicting might happen. So that's why he took the position on it, and he managed his risk. So therefore, he's going to get value out of his futures contract, and we call that futures gain. But then he also has those cattle sitting in those pens. What happened to them? Well, the cash market fell. So he obviously didn't want it to happen, but he was protecting himself against. So he sold those cattle at a lower price. These won't be exactly equivalent, but the theory is that they do equate themselves in the bigger risk picture. So you have your money gained back on the futures, but you lose it on the cattle. Conversely, same situation, but there's a market rally. So we can all predict what we think is going to happen with this graphic. Feeder cattle futures go up. So you have futures losses now. So you have to pay into the CME, and that's called a margin call. So that's because your contract is basically, you guessed wrong. So it's lost money. You have to pay that to the other person on the other side of the contract. You don't actually pay it to them. You pay it to the CME or your broker. But that's the theory of it. Or cash market rallies. So now you've got that local cash market to sell into, and the cattle are sold at higher price. So either way, you're still offsetting your risk. And the people that are speculators, if they guess right, that's where they're making the money. But you guys, as owners, will be offsetting that with your risk on the physical commodity. But I made it sound somewhat simple, at least I hope. But there is some Canadian complications. So hedging on the futures market isn't as straightforward for Canadian producers like it is the US, because obviously CME is all US based, whereas we have a different currency up here. So we have to take into account the currency. To truly hedge your risk, you would need to take a position on the Canadian US dollar for the Canadian dollar going up, and that would be called a long position. And then there's also the basis that we experience here in Canada. Both Anne and I have mentioned it. It's the hardest to predict and the hardest to manage. But there is, well, forward contracting would lock in your basis because that's your price. And CPIP also does lock in that basis for you because we've forecasted into our price projections. Sorry, again, on the slides. Let's talk last a little bit about cost. So the primary cost of implementing a marketing strategy and a risk management strategy is time. You have to put the time in to build some relationships, crunch your numbers, figure out what works best for you. They all do have some cost to them, well, except for no risk management, knowing what those costs are, but I think more so it's the intrinsic cost of the time it takes to get yourself up to speed on what you want and what your operation will fit best. That said, not the same, it's not going to be the exact same every year. As I'll go in my examples, you'll see that every year there's one of the programs works better. We would all need a crystal ball to predict that, but knowing that there is tools helping you manage that risk. I've mentioned that non-Canadian risk management strategies do require you to do the opposite side of the currency, but with the futures and options, but more so futures, there is more risk and there's more potential reward. So it depends on how risk averse you are, but some of the safer products are more the Canadianized products, and that's going to be forward contracting or the cattle price insurance program. And lastly, you can't control the weather, but it can seize opportunities to secure some profit and some losses. Now I'm going to move into my examples. So now I've done the theory part of the presentation. I'm going to try to make it applicable to a cow-calf producer. So to set that up a bit, I'm going to talk about a producer selling calves in the spring. He's going to wean them mid-October at approximately 600 pounds, and he's considering the first three risk management options. Option one, this is 2017, remember. So he sold through the local auction market. He receives approximately $225 per hundredweight. That's based on October 16th. Our CPIP was settled at $225.85, so I rounded down a bit just to give us a benchmark. So his average on a 6-weight is going to be $13.50 per head. And that's total cash he comes out of the market with. Cost of that, risk management, was zero. Trucking, $3.50, commissions, fees, $28. So his net on no risk management this year in the market was $13.18.50 per head. Good, we're all happy. Option two, forward delivery. So this same thing is a setup for September sale of the cattle, but not delivered to October. So they're still the same cattle. They're still going to wean mid-October and 6-weight pounds. But he's going to sell them before the market rallied a little bit. So that came in on average at $210 per hundredweight on the electronic side of it. I took one that had a per head commission, so I averaged that about 18. So his net this year, had he forward sold on an electronic sale in September, would have been $12.42. But again, it was before the market rallied. So back here, he's netting $13.18 out of the auction market. Here on an electronic sale, he's $12.42. Option 3, Western Livestock Price Insurance Program. So you still have to sell at the local cash market because we're not creating a market for you. So we're going to assume that you're receiving $13.50 per head, and again at that $225. The cost for this, though, now we have a cost for that risk management, and that was coverage level purchased at $222 at the last day of May. For my example, it cost $739 per hundredweight, which is a total premium of $44.34 per head. Indemnity was 0 because the market outperformed what the price insurance was your coverage level. So the market was above what you had insured as your floor price. That's why there's no indemnity. Trucking $350, commissions $28. So your net on using the livestock price insurance was $1,274. So that's the same as no risk management, just net the premium. But that said, so like I said, this year market rallied. We didn't really expect it as strong as it was. Best one to do was to be totally on the open market, no risk management. You made the most money. But everybody remembers 2016, and it was a very different story. So had there been no risk management, you would have had, I was calling the market mid-October of 2016 at a 171, so that gives me my 1026, and then 1026 down here, because these are the same outlets, whereas this one, they sold in September, and then the market started its decline to bottom out in October, so they were a little bit ahead of the market. So I'm calling that one at a 184. So that's the difference there, but then they still had the same commissions and trucking. So your net last year, return on no risk management was $994.50 per head. Forward delivery, because you sold ahead of the market decline, 1086, but then your Western Livestock Price Insurance with your net premium out of there is 1098. So your net benefit is 104.40. I'll let that one sink in for a minute. Bruce, you're scowling. Bruce was a mentor to me, so I'm giving him a hard time because he's local. So option 4, forward contracts. I didn't actually put any numbers to this because it is all hypothetical. I'm not going to guess at what feedlots we're offering. I just know that there wasn't a lot available out there because there was a bearish tone to the market. It's dependent on relationships, and there will be year-to-year fluctuations to it. And then I do go into the futures hedging. I'm not going to actually simulate a contract because I don't think that's what's necessarily applicable for cow-calf producers. I would tell my dad I don't actually care if he understands how to execute a contract. I would care for him to know what the futures do to impact his price at the local auction market and how it's going to work itself back to what the cash market's doing here in Alberta. That's what I would care for him to know. So I say that watching the numbers helps make this decision. So let's take, for example, 6-weight calves. We're selling them in October. Well, when are they going to actually be ready for equivalencies of those futures contracts? Well, they'd be either June live cattle or March feeder cattle. Those are the ones to watch and how they're impacting your October 6-weights. So for example, if we were to look at the June 2018 live cattle contract, I'm going to do that right here. On May 29th, which is when we were looking at the CPIP program, the close for that day on the live cattle for June 2018 contract was 111.75. But then October 23rd, when we sold those calves, it was 117. So now we've got a gain on the futures market of 525 US. But we would have had to pay our margin call on that had we actually taken that contract, and it would be over 50,000 pounds. So now we're looking at 26.25 US. That's a change in the contract that we took, so we'd have to pay that extra for our risk management. But this is what we gained on the market, and this is what also is one of the contributors to what the cash prices did and the calf price. Because now that those calves being bought, the future projections for those fed cattle when they're going to be ready for slaughter is higher. So now there's more willingness to pay for those calves. But again, we have to back it up to Canadian relevancy. So we have to take into account the 1 cent down equals 5 cent gain on 550 calves. I just want you to know those risks and know how they impact you. I don't actually care if you dig into figuring out what the futures would do for you. I feel like I would be a little bit remiss if I didn't show the graph of the live cattle contract and how it traded from when we were starting our calculations May 29 to when we sold those cattle October 23rd. There's all these fluctuations in here. So here's going to be your margin call. Nope, here's going to be your margin call. Here's going to be your gain on those cash cattle. And it fluctuates up and down until you're ready to get out of that contract. So let's do some quick math, because I feel like this is what really we could drive home to some of the cow-calf producers, doing some predictions on your own based on what the futures are doing. So now I'm going to flip to a feeder cattle contract. I'm going to leave live cattle contracts behind, and we're going to look into March for feeders. So I did this on November 1st. Looking into March, we closed November 1st, 157.15. The currency, now you have to look for your currency into the future too. It's not going to be as big of an impact change-wise as if you were to take the spot, but we're still looking at forward for March contract, 77.65. So this is what we calculate, 157.15, that's futures divided by the currency, gives us a forward-looking feeder cattle expected price in March of 202.38. But we've still got this basis. So this is where it gets really complicated. And everybody figures out their basis differently, but our 3-year average is a minus 16. So this graph is available on the AFSC website. You can see this gray line is where we're at the 3-year average. That's minus 10. But as Ann said, we're going to be, for live cattle, we're going to be at a minus 3 over the year. So I just took a current basis projection as best I could, knowing that we have to take a look at the historical, because the only way to predict the future is to look at the past. So that's going to always be an impact on our basis, but also we're at a different trading range than we ever have been. So we have to make those two marry up somehow. So I took a basis of projections for March at a minus 550. So now we've got our Canadianized forward-looking price. We take off that basis. So I can, on November 1st, I could fairly confidently predict that I think March feeder cattle would be worth about 196.88 in Canada. Now to take that back again, if you were to think about that as for calves, you would have to then do a calf to feeder spread. But if you were to compare this directly to the cattle price insurance program, on that day, we offered coverage at about 188. So if you took 95% of 196.88, you get around 187 and change, and we round up. So that's how we get our forward-looking price, and that's as simple as the math as we can get. Basis is what's going to be a bit different. I mean, we're never going to be exactly the same on basis, but you can get yourself to as close to the CPIP as you can be. It also helps you know the math that's going behind forward contracts and know how you can assess those numbers that are being offered to you before you sign on the dotted line. And lastly, I'm going to round this out with just a little bit of a view of what other risk management views are from a producer perspective. We have, within the Western Livestock Price Insurance Program, we expanded in 2014. We included the other 3 provinces as a mandate for some of that federal funding. There was a requirement for us to do a feasibility study. Part of that came out as a survey to producers that have interest in the program or are aware of the program. We then took a look at all of their answers for risk management, and I wanted to share those with you today because I feel it just gives you some food for thought. So 67% of cow-calf producers, now these results are Western Canada, so it's not just Alberta, but 67% of cow-calf producers increased the use of risk management tools over the past 5 years. That makes me happy. That shows that people are digging in and seeing that there is the volatility that they can protect against. But where did they use them? So tools used in 2016, cow-calf producers, 6% went on the futures and options, 6% did forward contracts, 47% did a Western Livestock Price Insurance policy, and 42% were at option number 1, and they had some diversity in their operation. They didn't specifically take risk management on their cattle, which is okay. Next up, we're going to talk about the use of them changing in the next 3 to 5 years. And I find this is where it gets more interesting, because that's fine what's done in the past, but what are we going to do in the future? So blue is decreasing, red is no change, green is increasing. So WLP policies, 43% expect to use more into the future. I have to caveat this slide with that it isn't just cow-calf producers. There is going to be some feedlot and some backgrounders responding to this survey as well. So keep that in mind. But 26% do see themselves taking a look at some futures and options. 31% are going to see what forward contracts are available for them. And 25% expect to continue, or even more so, take the risk on themselves, whether it be diversification or even off-farm jobs, really. Factors taken into account when using a risk management tool. Everybody kind of wants to know, how do you gauge if it's good or not? So I thought I'd throw this up there. The highest priority is going to be the coverage level. So that's your blue line over here. Makes sense. I mean, if it's not the coverage level you want, or it's not making your margins or your break-evens, what's the point of it? You could stay on the total open risk, and that's fine. So most people take a look at number 1, priority coverage level. Second is premium cost. Third is convenience. Fourth is the policy length or the expiration date, which I kind of find a moot point because you should be lining that up anyway, because that's the true hedge, is managing what you're ready to take on that risk in the cash market. So number 1, coverage level. 2, premium cost. 3, convenience. And lastly, I want to talk about the primary sources that producers that we surveyed get their advice from. The winner is auction market representatives at 21%. Secondly, we've got another producer, so that could be your neighbor at 16%, market analysts at 16%. The agency offering price insurance, so us, is 12%, and then CME website or other internet-based market analysis is 14%. I say this only because I think it's really important to dig into what opportunities we have available for Canadian beef producers is huge. We've got a lot of resources, even in the US. There's a lot of market analysts that write really good stuff every week. Find a guy to follow. Find a lady to follow. There's one in the room. Do it. Because auction market representatives, they're always there for their own betterment. They're running a business. They are very knowledgeable people. I don't want to discount that at all because we need them to keep the cash price discovery for calf and feeder. But I think that we need to start moving this pie chart a little bit over to down here to get some more timely, current, and unbiased information. So that's my soapbox. In conclusion, decisions have to make sense for the operation, and the same decision won't be right every year. So dig into your numbers, know what tools are available for you, and find a good market analyst that you trust and listen to them. Thank you. If you have any questions, I will be here through lunch. I also have my mentor is here, Bruce Viney, so if I can't answer it, he will.
Any questions for Brenda? Let's take Brenda for a question.